All right, let's dive right in. Today we're talking about something called the three-bucket strategy. It's a really simple but powerful way to set up your investments to pretty much bulletproof your retirement income, even if the stock market decides to go haywire.
I mean, think about it. It is the absolute worst nightmare for anyone about to retire. You work your whole life, you save, you plan, and then bam, the market crashes right when you need the money most. But what if I told you there's a way to structure your finances so that even if the market completely tanks for the next 5 years, your retirement income wouldn't drop by a single penny? Well, that's exactly what we're going to cover. You see, the biggest threat you face as a new retiree is something financial planners call the retirement danger zone. This is that super critical 10-year window. We're talking 5 years before and 5 years after you retire, where your entire life savings is at its most vulnerable. Now, the specific risk we're talking about here has a fancy name, sequence of returns risk. But all it really means is that the order in which you get your investment returns matters way more than your long-term average. Getting hit with a bad market right at the start of retirement can be absolutely catastrophic.
Just think about it this way. If the market drops 30% in your very first year of retirement, you're suddenly forced to sell your stocks at a huge discount just to pay for things like groceries or property taxes. You end up having to sell off so many more shares than you planned, which is like cannibalizing your own portfolio. It eats away at your nest egg so fast that it might never, ever recover. To really drive this home, let me tell you a quick story that shows just how much this sequence of returns actually matters. Okay, so let's meet Cindy and Scott. Now look closely. They start with the exact same amount of money, $1,000,000. They withdraw the exact same amount, $40,000 a year, and get this, over 25 years, they both get the exact same average return of 9.3%. The only, and I mean only difference, Cindy gets lucky with strong returns right out of the gate, while Scott gets hit with a bad market in his first few years. And the outcome? It's staggering. Because Scott had to sell his investments when they were down early on, he completely runs out of money. He ends up with zero, nothing. Cindy, on the other hand, she ends up with over $3.8 million. I mean, think about that. Same money, same withdrawals, same average returns, but wildly different results. That right there is the terrifying power of sequence of returns risk. So, of course, the million-dollar question is, how do you make absolutely sure you end up like Cindy, even if the market crashes the day you walk out of the office for the very last time?
Well, the answer is a beautifully simple framework called the three-bucket strategy. The whole idea is to separate your money into three different pots, based entirely on when you're actually going to need to spend it.
And the structure is incredibly intuitive. You've got a bucket for your now money for what you need right away, a soon money bucket for the medium term, and then a later money bucket for your long-term growth. It's that simple. Okay, so let's get into the nitty-gritty. Let's see exactly what goes into each of these buckets and why this system works so incredibly well. We'll start with the most important one. Bucket number one is your now money. And you can think of this as your financial firewall. It is your absolute first line of defense against a market crash and the foundation of your security in retirement. So this bucket holds about 1 to 5 years worth of your living expenses in super safe liquid stuff like cash or a high-yield savings account. Now, why 5 years? Well, if you look back at history, that's roughly how long it takes for a really nasty bear market to hit bottom and then fully recover. With this bucket full, if the market crashes, you don't panic. You don't sell a single share of stock. You just live off this cash and patiently wait for the recovery. Okay, next up is bucket 2. This is your soon money, and its job is basically to be the bridge between your short-term cash and your long-term growth investments. This bucket is designed to fund your 6 through 10 of your retirement. It holds more stable investments, things like high-quality bonds or conservative ETFs. The goal here is pretty simple. Earn a little bit more than cash, but without all the crazy ups and downs of the stock market. And it also acts as a critical backup to refill bucket 1 if a downturn ends up lasting longer than you expected. And that brings us to the engine of your entire retirement plan. Bucket number 3, your later money. This is your long-term growth portfolio. This is the money you know for a fact you won't need to touch for at least 10 years. So you fill it with things like stocks, growth funds, and maybe some real estate. And because you have such a long time horizon, you can completely ignore the day-to-day market noise. This is the bucket that you let ride the waves, grow aggressively, and make sure you beat inflation and never outlive your money. This is what gives you that Cindy outcome, even if the market gives you a Scott start.
Now, you have to understand, this strategy is about so much more than just numbers on a spreadsheet. It's really about your quality of life, your peace of mind in retirement. I mean, let's be real. You didn't work for 40 years just to spend your golden years glued to the financial news, sweating every little dip in the market. As it says here, money is just a tool. It's a tool to help you build the fulfilling life you've always wanted. And that right there is the real superpower of this whole thing. When you know you have your next 5 years of living expenses sitting safe and sound in cash, you buy yourself ultimate psychological freedom. You can sleep at night. You can book that trip you've been dreaming about. You can go out to dinner with your friends, spoil the grandkids, and do it all completely stress-free, knowing that a market crash won't change your lifestyle one bit. So if we boil it all down, the three-bucket strategy protects your income, it massively reduces your financial anxiety, and it stops you from making those emotional mistakes like panic selling at the worst possible time. But most importantly, it gives you the confidence to actually go out there and spend and enjoy the money that you worked so incredibly hard to save. And that really just leaves us with one final question for you to think about. Is your current retirement plan actually organized to protect you? Or is it just one big pile of assets leaving you totally exposed? Is it truly designed to give you peace of mind?